Hello everyone. Bitcoin just hit $110,000, a milestone that has the entire crypto community celebrating. From MicroStrategy to retail investors, from Wall Street analysts to crypto Twitter, the sentiment is overwhelmingly bullish. Predictions of $150K, $200K, even $2.4 million by 2030 are everywhere. But here's what concerns me. When everyone is looking in the same direction, that's precisely when we need to look the other way. Today, I want to examine the real risks facing Bitcoin at these price levels. Risks that could potentially send it back to $50,000 or lower. I'm not here to be a bear. I still hold Bitcoin as my largest crypto position. But after 15 years in markets, I've learned that the best time to discuss risk is when nobody wants to hear about it. So let's dive into what could go wrong. The biggest risk facing Bitcoin today isn't regulatory or technical, it's mathematical. We're sitting on a leveraged time bomb that's grown exponentially since the last cycle. Let me break this down with real numbers. According to recent data, cryptocurrency-backed loans have reached approximately $39 billion. To put that in perspective, at the 2021 peak, right before Bitcoin crashed from $68,000 to $16,000, we hit $65 billion. We're approaching that same danger zone. Here's how this works. Investors take their Bitcoin to platforms like Aave, Compound, or centralized exchanges and borrow against it. Current loan-to-value ratios typically range from 50–80%. The borrowed funds often go right back into buying more Bitcoin, creating a feedback loop. When prices rise, this works beautifully. Your collateral value increases, you can borrow more, buy more Bitcoin, and the cycle continues. But when prices fall, the mathematics become brutal. Let's say you have $100,000 in Bitcoin at a 70% LTV ratio. You've borrowed $70,000. If Bitcoin drops just 15%, your collateral is now worth $85,000, but you still owe $70,000. Your LTV ratio jumps to 82%. The platform sends a margin call. If you can't add collateral and Bitcoin drops another 10%, you get liquidated. Here's the terrifying part. Each liquidation creates immediate selling pressure, which drops the price further, triggering more liquidations. This isn't theory. We watched it happen in real time during the Terra Luna collapse and again during the FTX implosion. But individual leverage is just the first layer. We now have a new phenomenon, corporate Bitcoin leverage, led by MicroStrategy and increasingly copied by other companies. MicroStrategy has issued billions in convertible bonds to buy Bitcoin. When Bitcoin rises, their stock price soars. They can issue more debt cheaply and buy more Bitcoin. It's financial engineering at its finest. The problem? Their own SEC filings warn that if Bitcoin prices fall significantly, they may be forced to sell Bitcoin to meet debt obligations. And now, dozens of companies are copying this playbook. Take Metaplanet in Japan, a struggling hotel company that pivoted to the MicroStrategy model. Their stock went from $20 to $1,500 in months. Marathon Digital, Riot Platforms, CleanSpark, all using variations of this strategy. Why is this dangerous? Because these companies didn't diversify into Bitcoin, they concentrated into it using borrowed money. When the unwinding begins, it won't be gradual. It will be forced selling by entities that have no choice but to sell. Bitcoin's market structure has also become more fragile. Most trading now happens on a handful of exchanges, with much of the volume concentrated in derivatives rather than spot trading. The Chicago Mercantile Exchange Bitcoin futures market regularly sees 3 to 5x the daily volume of actual Bitcoin spot trading. When leverage unwinds in derivatives, it creates massive pressure on the underlying asset. We've also seen the rise of Bitcoin ETFs, which, while positive for adoption, create new systemic risks. These ETFs don't always hold the Bitcoin they claim to represent through complex, authorized participant mechanisms. During stress periods, the premium discount to net asset value can create additional volatility. Consider this. If institutional redemptions force ETF providers to sell large amounts of Bitcoin quickly, there may not be enough spot market liquidity to absorb those sales without significant price impact. Beyond leverage, Bitcoin faces several technical challenges that markets haven't fully priced in. Mining centralization continues to worsen. Recent estimates suggest just 4 mining pools control over 60% of Bitcoin's hash rate. While this doesn't immediately threaten the network, it creates concerning bottlenecks and potential points of failure. The quantum computing threat, while still years away, is accelerating faster than many realize. Google's recent Willow chip represents a significant quantum leap. While Bitcoin's cryptography remains secure today, the timeline for necessary protocol upgrades may be shorter than anticipated. Energy and regulatory pressures are also intensifying globally. Several countries are restricting or banning Bitcoin mining due to environmental concerns. This geographic concentration of mining increases centralization risks. Let's look at history. Bitcoin has experienced four major corrections of 70–85%. 2011 from $32 to $2, 2013, 2015 from $1,200 to $200, 2017, 2018 from $20,000 to $3,200, and 2021-2022 from $69,000 to $15,500. Each time, the dominant narrative was that Bitcoin had matured and wouldn't see such dramatic drops again. Each time, that narrative proved wrong. At current prices, a similar 75% correction would take Bitcoin to approximately $20,700. While that sounds extreme, it's exactly what happened in previous cycles when leverage reached extreme levels. The difference this time is the scale. With corporate balance sheets, ETFs, and institutional investors now heavily involved, the forced selling could be more severe and longer lasting than previous cycles. So what should you do with this information? Here's my framework. First, honestly assess your leverage. If you're borrowing against Bitcoin, using margin, or in any way amplifying your exposure, understand that you're playing with fire at these levels. Second, consider position sizing. Even if you're bullish long-term, these price levels require smaller position sizes than previous cycles. The risk-reward at $110,000 is fundamentally different than it was at $20,000. Third, have a plan for drawdowns. If you can't psychologically handle Bitcoin dropping to $40,000, $50,000, your position is too large. Plan your exit strategy before you need it. Fourth, diversification matters more at extremes. When Bitcoin was $5,000, concentration made sense. At $110,000, diversification becomes more important. Look, I want to be clear. I'm not predicting Bitcoin will crash tomorrow. Markets can stay irrational longer than we can stay solvent. Bitcoin could easily reach $150,000 or $200,000 before any significant correction. But when that correction comes, and history suggests it will, the combination of individual leverage, corporate leverage, derivatives, and institutional involvement could create a perfect storm. The best investors I know aren't the ones who predict every move. They're the ones who survive every cycle, and survival means respecting risk, especially when nobody else wants to talk about it. That's why we're having this conversation now at $110,000, not later at $50,000, when it's too late to do anything about it. If this analysis helped you think differently about risk management, please like and subscribe. And remember, in markets, the goal isn't to be right about every move. It's to be positioned to survive and profit regardless of what happens next.